Banana hunt is an old school term for a well-known trading concept called mean reversion. At its core, this strategy identifies moments when a stock price moves too far away from its real value, what we call the banana line, due to extreme market emotions like greed and fear. The goal is to spot these deviations, understand the underlying reason behind them, and position ourselves for a trade when the price inevitably reverts to its fair value. To truly understand how to find a banana hunt setup, we must first break down spreads, one of the key indicators that reveal when a stock is moving into extreme overbought or oversold territory. Understanding spreads in trading. In trading, the term spread refers to the difference between two prices. There are different types of spreads, but for our purposes, the most important one is the greed-fear spread, the gap between a stock's current market price and its real value, or banana line. When a stock's price surges well above its banana line, this is a sign of extreme greed in the market. Traders are chasing the price, believing it will continue rising indefinitely. On the flip side, when a stock's price drops far below its banana line, it signals extreme fear. Traders are panicking, selling off their positions without considering whether the price will eventually stabilize. This spread between the current price and the banana line creates trading opportunities. The larger the spread, the more potential there is for the price to revert back to its mean value. Identifying greed and fear in the market. To successfully find banana hunt setups, we need to understand how greed and fear manifest in stock prices. These emotions are the driving forces behind the most explosive price movements, and recognizing them early gives traders an edge. Greed. When the price goes too high. Greed occurs when buyers push a stock price far above its banana line, believing it will continue to rise. This is often triggered by hype, positive news, or FOMO, fear of missing out. Here are some key signs of extreme greed. The stock price is trading significantly above the banana line. Volume is much higher than usual, showing aggressive buying. The RSI, Relative Strength Index, is above 80, signaling overbought conditions. The stock experiences parabolic price movement, meaning it's rising too fast without pullbacks. At these moments, buyers are caught up in euphoria, convinced that the price will keep climbing. However, the reality is that such moves are unsustainable. Eventually, the stock will lose momentum and start reverting back to its banana line. This presents a shorting opportunity or a chance to avoid buying at inflated prices. Fear. When the price drops too low. On the opposite end, fear drives stock prices well below their real value. This happens when traders panic, dumping shares without rational analysis. Fear-driven moves are often triggered by negative news, market crashes, or general uncertainty. Signs of extreme fear include the stock price is trading far below the banana line. Volume spikes on heavy selling pressure, showing panic liquidation. The RSI is below 20, signaling extreme oversold conditions. The stock is experiencing huge intraday drops with little recovery. During these moments, traders overreact, selling at irrationally low prices. However, just like greed-driven surges, these fear-driven declines don't last forever. Eventually, the price stabilizes and bounces back toward its banana line, creating a strong buying opportunity. The banana line, finding the real value of a stock. The banana line is a critical concept in banana hunt trading. It represents the real value of a stock, the price at which it should trade under normal market conditions. The banana line acts as a gravitational center for stock prices. No matter how far a stock deviates due to greed or fear, it eventually finds its way back to this equilibrium. This is what makes mean reversion strategies like banana hunt so powerful, because prices do not stay in extreme zones forever.